I'm Nona Grayson,
And I'm Chira Lask.
and we are excited that you're joining our webinar of renting. Then you're already paying a mortgage, just not your own. So, to tell you a little bit about us, I am a realtor with First Team Real Estate. Chira is a local mortgage professional. She's been in the industry for 14 years and works for Homeowners First. We are going to talk about buying versus renting here. The purpose of this seminar is to explore the benefits of buying and owning a home, as well as looking at the rent versus buy in the larger context of wealth building. And Chira is going to do the majority of the presentation. I've asked her, she is a mortgage professional extraordinaire and is going to tell us and give us some facts and put some numbers together to show you how within 10 years you can build wealth in real estate.
Fantastic.
So why consider buying? If you are debating about buying and renting, there are plenty of factors that you should keep in mind. So Zillow came out with a statement that over the next 12 months, rents are expected to grow at a growth higher than inflation, the stock market, and home values. Also, rent growth is expected to continue. As you can see here, 2023, the forecast was for rents to increase 6.3%, and we've just seen the new figures where rent is increasing, forecasted for 2024 at 7.1%.
Wow.
This is a chart that just shows a little bit of a contrast between renting versus owning. As you see on the left, when you rent, you're building your landlord's wealth. You're paying off his mortgage. Your monthly payment generally goes up each time that you sign a new lease or renew your lease. Rental prices, appreciation, it puts a pinch on your wallet and it has no benefits to you. And as rents rise, it's harder to save for a down payment and escape the cycle of rising rents. On the other hand, when you own, you're building your own wealth. Your monthly payment is locked in for the length of the loan, usually 15 to 30 years. Home price appreciation pads your pockets by growing the value of your investment. And over time, you can build equity and your net worth, which helps you fuel for your next home purchase. Two more things about the difference between buying and home ownership is that when you own a home, you have much more flexibility to remodel, to paint any color you want, to make any design changes or upgrades, whereas renters have a very limited option of what they can do to customize their space. And then probably the most significant thing of all about buying is that a monthly mortgage payment is often considered a forced savings account. And that helps homeowners build a net worth about 40 times higher than those of a renter. And this was from chief economist from the National Association of Realtors. Now I'm going to turn it over to Chira, who is going to give you some numbers and show you how it all makes sense.
So thank you so much, Nona. I think those are some really important facts that we can look at when considering purchasing versus renting. And I know a lot of people out there, would want to purchase, but there's some of them may be wondering what their monthly payment looks like, and the whole process may seem pretty daunting. What I wanted to show with this very specific example is how renting versus purchasing a townhome in Aliso Viejo, in the city of Aliso Viejo, where you farm, looks like from the standpoint of finance and monthly payments. So I know these are a lot of numbers, but I want to take into account really quick the renting data. So basically in Aliso Viejo, a townhome would rent somewhere around $4,000. You will have to pay some renter's insurance. So basically your monthly payment would be somewhere around $4,150. We expect that rents will continue to increase, like Nona said, about 7.1% projected for next year. But I took a slightly more conservative number. Even if rents increase at 5%, once we see the whole calculation, we want to see where the rents would be in a few years. We are looking at a property that's worth 800,000. Property taxes are roughly 1% per year. You will have to pay mortgage, homeowners insurance on any mortgage on a property you own. And then we accounted for HOA and monthly repairs of about $500 per year. And this would be for the loan part, we are considering taking a loan of 720,000. That means you would have to come in with a 10% down payment. Current interest rates are pretty high. They're probably slightly higher than 7%, but we're hoping that in the next month or two, they'll level out a little. So for the interest of this illustration, I took into account the 6.99% mortgage interest rate. Every time you have a loan where you do not have a 20% down payment, you will have to pay mortgage insurance. And we took into account about $16,000 worth of closing costs. Now, the most important part, what we're going to take into account in our calculation is what will this property, or what is this property projected to appreciate in the next 1 to 10 years. So the historical appreciation, so basically increase in property value, it's about 5.3%, but forecasted is actually a little higher, almost 6%. We also want to showcase that when you own a property, you will have income tax, or actually tax deduction. So depending on your filing status, as a homeowner, you have specific tax deductions that help you lower the taxes you owe at the end of the year. So in this slide, we are showing what's the cash flow. Basically, how much do you pay in monthly mortgage payment plus all the other expenses, so monthly housing expense versus renting. So as you can see, in the first year, definitely paying a house for your own home is more expensive because we have a pretty high interest rate, and the monthly mortgage payment includes property taxes, insurance, principal, interest, all of these things, HOA, maintenance, comes to almost $6,300. So rents are roughly $2,100 less. That's substantial, right? However, as you can see, over the next 10 years, we know the mortgage will stay the same if you don't refinance, sell, whatever, but the rents will continue to increase. At some point, year 10, they will exceed. In year 10, the rents will exceed the monthly mortgage payment, even at a higher interest rate. Over 10 years, yes, you will pay $137,000 more in monthly mortgage payments or housing payments, I would say. However, at the end of 10 years, you will have built-in appreciation, meaning the difference between what the property value at the end of year 10 will be versus what you purchased it for. So that number is about $619,000. So if you don't sell the property, that will be built-in equity. But if you sell it, you will have a cost of about 6%, $85,000. And the leftover, so the appreciation gain minus the cost to sell will be somewhere at $500,000. We'll look at that in a minute. In the meantime, your forced savings, whatever the principal you pay into your loan, will be $100,000. So over 10 years, you've saved $10,000, roughly, actually $8,000 per year. So $100,000 over 10 years. The tax benefit is about almost $64,000. So because you own a home and you have specific deductions, you will pay less in income taxes. So as you can see, if you paid in rents $137,000 more over 10 years, in mortgage interest and mortgage payments, 137 more than renting, that $64,000 reduces that amount to only $70,000. So basically in over 10 years, you paid $70,000 more into your own home. But at the end of year 10, if you decide to sell, after you pay, taking into account the cost for you that you paid at purchasing, how much more you paid in rents, and how much it would cost you to sell, you still have a net gain, a net profit of over $500,000. So when you rent, you don't have that opportunity. That money will not manifest for you. So it's clearly such a great advantage to build family wealth, to build generational wealth by being and striving to be a homeowner. Nona, any questions for me so far?
No, I think it sounds great.
Excellent. Thank you so much. So we saw that by the end of year 10, you could potentially have more than $500,000 in net profits if you sell the property. And if you don't, you can still access those $600,000 by equity line of credit, or there's ways you can pull money out of your property and buy another one in the future and, continue this cycle of home ownership. But from Nona's experience and mine as well, we know that there's, as a potential home buyer, there's a lot of arguments against home buying, or maybe obstacles that our prospects see. And some of them would be definitely the current high interest rates, which lead to high monthly payments, and little or no savings for down payments. Most people don't have sufficient savings, difficulty qualifying, and then a lot of people are asking, is this the right time to buy? We hear this very often when we talk to our clients, because they wonder if the market's gonna go down, so prices will go down, or what's happening. And maybe, Nona, you can talk a little bit about this one here, and I'll take the other three objections, and then what are our solutions to them in terms of, is this a right time to buy?
Well, yes, and as Chira had talked about, the main thing about buying real estate is staying in it for the long haul, and that's where you are going to develop wealth. Now, the market does go up and down. Interest rates go up and down. It's I wish that I had a crystal ball. I would be rich if I did. So I can't really say on my own what I think that the market is going to do. So I rely on economists that are way more experienced in the market, and what they are saying is that prices are projected to continue to increase.
Yes, and we've seen this even recently with the most recent Case-Shiller price index, that we've had an appreciation, the highest in recent months. July of this year versus last year, we had actually versus prior month was 1.5%. So prices went up in July versus June by 1.5%. The other things I wanted to address here. So yes, we know the interest rates are high, the monthly payments are high, and to counter that, we have this technique, or whatever, this process that we call a seller paid buy down. It's basically a temporary rate buy down that it's possibly available to buyers depending on what property we're looking at. So basically what this means is that the seller can contribute a certain amount of funds to buy down the interest rates by 2 points in the first year of the loan and 1 point the next year. And the hope is, and the expectation, that at the end of year 2, we could refinance the home buyer into a new loan at an even lower interest rate. So if this works out, we would save, by lowering the interest rate by 2 points, we would lower the monthly payment by $900. So now instead of a $6,300 monthly housing payment, it will be somewhere about $5,400. The next year, it will be roughly $500 less. So that brings the payment to about $5,800. So this is something where the seller would pay a combined credit of almost $17,000 to buy down the buyer's interest rate. Now, in terms of down payment, there's a lot of, well, at least 3 specific programs that we have in mind. Basically, they're down payment assistance programs where the minimum down payment can be provided by the California Housing Finance Authority in form of the second loan that doesn't have a repayment, and it's called a silent second. So it's not like you're gonna have two mortgage payments. It will be just the main mortgage payment, and then the down payment assistance loan can be paid off at a later time when the property is sold or refinanced. And we also know that a lot of potential buyers like yourself may have issues with their credit. That's something we can help with as well. We have a program in place that helps with credit upgrading or credit FICO enhancement. So we can work with you in identifying what actions need to be taken for your FICO score to increase, because that's very important in terms of what interest rate you get on a mortgage and also the monthly mortgage insurance. Also, there's programs where the debt to income ratio is allowed to be higher, so that allows you to qualify for as much as possible with the income that you have. And so these are just some of the obstacles we came across in speaking with our buyers and borrowers. And hopefully these are some of the ways that we could help you as well. What I wanted to show, though, is that from, like Nona was saying, the market economists, the market analysts on the mortgage side of the market predict that within the next 2 years, we should see a decrease in mortgage rates. So then I wanted to show what the mortgage payment and the housing payment and also the wealth building would look like if at the end of 2 years we lower the interest rate from 6.99 to a 5%, so 2 points lower permanently. So in this case, the monthly mortgage payments, or housing payments rather, because it includes everything, goes down almost $1,000 to $5,370. It's still higher than renting, but by the end of year 10 is a lot lower than renting, considering that the rents will continue to appreciate. So now the difference between the two is roughly, it's less than $2,000 in the beginning, because in the beginning it's more expensive than then, but then about year 6 it levels out where the two are almost equal. The nice thing is that at the end of 10 years, the appreciation, you know, if you were to sell the house at the end of 10 years, you would have an additional $100,000 in equity, assuming the projected price increase or value increase of 5.8%. So let's call it 6% to make it a little bit easier. So if we take that into account, at the end of 10 years, with a lower interest rate, you should have about $657,000 in net gains. That can, and if you don't want to sell your house, you can access the equity in the house through equity loans, you know, that can help pay the children's college, make improvements on a home, buy another investment property, or maybe a bigger house. The opportunities out there, but we have to start somewhere, and that's the whole purpose of this webinar, to show you some ways of possibly purchasing and how that would look like for a property in Aliso Viejo, for instance. So we know that changing your status from renter to owner can be intimidating. We see this every day with our clients, but when we take into account the long-term benefits versus the short terms, there's absolutely no question that being a homeowner has amazing advantages. Mm-hmm. Nona, is there anything else you would like to add?
No, just, you know, initially getting into the housing market might be some delayed gratification, and you might not get exactly what you want. Yeah, you might need to downsize a little bit, and the payoff in 10 years will be well worth it, and you'll be so glad that you did.
Yeah, absolutely. I can't tell you how grateful I am that we stuck through with our house through, you know, we had difficult times at some point, like any family has, but at the end of the day, after 20 years, it's an amazing asset. And especially coming from a family, well, not from a family of immigrants. I'm a first generation immigrant. I know it's so important. The American dream, I think, especially from coming from outside, is even more important. So I cannot stress enough the benefits and the privilege of owning a house here in the United States.
Absolutely.
Well,
Well,
wonderful.
thank you so much for joining us. Thank you, Tira.
You're
and
welcome.
for all
And thank you for having me.
Yeah, thank you for that great information. And we'd love to connect with you. Feel free to reach out to us. And you want to put our contact information
Yes, absolutely.
again?
Here we are again, and we will email you. Probably we can even email the PowerPoint, but definitely hit us for any. We'll follow up with each of you, but we will. Please feel free to reach out to us by phone, by email, and in any way we can help. There's absolutely no obligation. We're here to help you in any way possible, to guide you and to inform you. And then you can make the decisions that are best for your family.
Sounds good.
Fantastic. Thank you so much, everybody.
Bye-bye.
Bye.